Okay, so cash flow forecast. This is one of the three financial documents you have to learn a lot of the time at A-level. Cash flow forecast, income statement, statement of financial position. Okay, so the cash flow forecast is really simple. We've got a definition here. It shows the money moving in and out of a business over a period of time. The big thing here is all it does is show the movement of money. Do not mention the word profit on any cash flow question because it doesn't incorporate profit. And I'll try and explain that in the video. So here, let me just explain the document then. We've got months vertically. So I've included 3 months on this cash flow. I've listed my inflows, kept it simple, 2 inflows, sales, selling our product in each month, and also we get a bank loan in January. Total inflows, I've added up all my inflows in each month, and that's what I get. Outflows, kept it simple, my business only has rent and wages, total outflows are here. So, let's just go through January. I've made 46 in sales, I've received 30 from the bank in a loan, I've spent 15 on rent, 28 on wages, and so all in all, my bank account has increased by a net cash flow, 33. So net cash flow basically means total inflows minus total outflows, your net cash flow. So positive 33 going into my bank account. Now to emphasize this point, I'm going to pretend this business is a brand new business with 0 in the balance, okay? My closing balance is 0 plus the 33 I made that month. This 33 carries over to the following month. I start February with 33. There's no transaction that happens that isn't recorded on this document, okay? So the 31st of January is going to be exactly the same as the 1st of February. Right, so in February, I've done my maths here. I get a positive net cash flow of 17. So my closing balance is 50. 33 plus 17, I've now got 50 in my bank account. This closing balance is showing me what I finished the month with in my bank account. So what do I start March with in my bank account? I must start with 50. Okay, so you see the 33 is what I start the next month with. I add the net cash flow, 50. I start the next month with 50. This month I make 16. I sold 73, I spent 57. That's a net cash flow of 16. I've got a positive closing balance at the end of 3 months of 66. Okay, so this is would be all in money. So I put it in thousands of dollars. So I've got $66,000 in the bank account. So what's the point of this document? Well, identifies when there may be cash flow problems. I don't have any cash flow problems here, but potentially, if my balance was less than 0, I need to think about what source of finance I need to use to manage my cash flow. Okay. Helps managers analyse where to make improvements. I can look at this document and I see a breakdown of all my costs, and potentially I can see, right, okay, something needs to be cut down if there's a really expensive area or if I'm not making money. It helps me understand and analyse my inflows and expenses. Encourage detailed planning. This is a forecast, so I've made this in advance. So instead of just starting business and thinking to yourself, okay, right, let's just see if this works, you have to sit down and actually work out how much money are we going to get in revenue. You know, what is our price and therefore how much do I have to sell in order to achieve these figures and a positive cash flow. So it forces you to sit down and do detailed planning. Used as evidence to persuade banks to give loans. Banks will say, right, show us your cash flow forecast in order to be able to be eligible for a loan. Evaluations, okay. If I'm going to say limitations of a cash flow, it's the fact that it's only a forecast. Many unexpected events could happen. There could be a breakdown in my capital which needs fixing. I could have a shocking March in terms of maybe I'm a business which I need good weather, and March is bad weather, so I didn't get any sales. So it's only a forecast, and therefore should be done probably fairly conservatively. Second evaluation, it does not show profit. I mentioned that at the start, but the reason this does not show profit is because profit is revenue minus total costs. Bank loan coming in, just because I've borrowed $30,000 from the bank doesn't mean I've made $30,000 profit. It's just money coming in. Okay, so when it comes to these revenues and costs, these aren't necessarily reflective like profit should be. Evaluation 3 must be used in conjunction with other docs to make a full judgment. We have a cash flow forecast, we have an income statement, and we have a statement of financial position. There are 3 documents the business has produced because they all do different things. So judgments are very hard to make if you only have one.